Welcome to Commerce and Management Solutions. Here, in this video, we are going to discuss about a theory, Marris model, which is come under the subject managerial or business economics. This is Robin Marris. He said that normally the business will aims to maximization of the profits, but he is saying that a business has to be concentrate growth maximization rather than profits. That's what his model, Mari's model, is commonly known as growth maximization model. This model had been published in Economic Theory of Managerial Capitalism in 1964. According to him, managers aims to maximization of the growth. Managers has to be aims to maximizing the growth, but shareholders always will aims at the maximization of their dividends and share prices. So manager will aims at growth maximization, shareholders aims at dividends and share price maximization. This has to be balanced. So that he is saying that in his balanced growth model, he is saying that managers aims at a constant growth rate at which the firm's sales, profits, assets, etc. grow. That means both aim, both the intention, both the objectives, both the parties' objectives has to be fulfilled by attaining the growth. So that he is saying that it has to be managers or business or firm has to be aims to maximizing the growth. So this theory is very good in the point of view of the utilities of both managers and shareholders. So to attain these utilities, as we all know, first you take to increase the growth. Business or firm has to spend some amount for advertisement. Of course, advertisement alone won't work. Many things are there, and but two important factors is advertisement and research and development. This both point has to be taken care. Research and development and advertisement. Then only the business or firm can retain a higher proportion of total profits, which leads to expansion of the firm. So that firm has to choose the growth rate that maximize the market value of shares, gives satisfactory dividend to shareholders, and to avoids the takeover of the firm. Firm has to choose growth rate that maximizes the market value of shares, gives satisfactory dividend to shareholders, and avoids the takeover of the firm. He's saying these things means maximization of growth. He's saying he's proving his theory by satisfying or by considering some of the assumptions. There are some basic assumption has to be followed to prove this theory. The first one is that separation of ownership and control. Separation of ownership and control. Managers are concerned with maximizing the balanced growth of the firm, but shareholders interested in dividends and share price appreciation. He assumes that managers always will concern with maximizing the balanced growth, but shareholders always considered to increasing the share price or market value. That is what the objectives can be attained. So this is the first assumption. Then next one is balanced growth objectives. Balanced growth objectives. The firm's goal is to maximize the growth rate of demand for its product and growth rate of firm's capital supply, that is GD and GC. So here the firm has to be look at the objective. Objective is that balanced growth. This can be attained by boosting the GD and GC. Means GD means growth rate of demand and growth rate of capital supply. GC is growth rate of capital supply. GD means growth rate of demand. This must be the objective of the firm. Then managerial utility maximizations. As everyone know that the primary interest of managers always will be like salary and their job security and power and status. This will lead to maximizing the growth of the firm. If the employees are getting, if the managers are getting proper salary, proper benefit, proper status, of course they will work anything like and they will get the proper benefit from the organizations. Then the fourth one is that managerial, that is profit as a constraint. Profit as a constraint. That is the fourth one. Here, the profit has to be the main important constraints, means they have to set a minimal level of profit. That means the firm should maintain minimum profit to satisfy the shareholders and to provide fund for reinvestments. Without profits, no business can survive. There is no doubt into that. So that here also, as per Baumol's theory also we discussed already, the profit is the minimum constraint. Here also profit has to be kept as a minimum constraint as assumption. Then market imperfections. Fifth point is market imperfection. Means this theory can be proved where the firm has to operate in an imperfectly competitive market. Then only this theory can be proven. Then the sixth one is risk aversion. Managers should aim for steady and sustained growth to avoid sudden financial distress or operational risk. Then the manager should be ready to take the risk at any time. Then only this theory can be proven. The next one is the last one, that is very important point, that is diversification. The growth has to be achieved through the diversification to stabilize the revenue stream. Without diversification, no firm can sustain. So it has to be diversified. So this all assumption has to be followed while proving the theory of Marris, means growth maximization model. So the first one is that separation of ownership then ownership and control, then second one balanced growth objective, third one managerial utility maximization, fourth one profit as a constraint, fifth one market imperfection, sixth one risk aversion, and seventh one diversification. This has to be considered. Then we know this theory how it will work. We can go for the graphical representation of this theory. He's saying that Maris is saying that she says that the objectives of the firm as to maximize its balanced growth rate, that is G. Objective of the firm is to maximize its balanced growth rate, G. It can be achieved through two factors. There are two factors have to be considered. Then only it can be achieved. It depends on two factors. The first one is that by increasing the growth rate, by increasing the growth rate of demand for the firm's products that represents GD. First factor is that increase the growth rate of firm's product demand for the products that represent as GD. It is managerial utility. It is a managerial utility function where managers will get or managers has to be concentrate or consist of emoluments and their status, power, job, security, etc. Means first part or first factor is all about managerial utility, managers utility. Then the balanced growth maximization can be increased by increasing the rate of growth of capital supply, which represents GC. Rate of growth of capital supply, GC, can be increased to attain the balanced growth rate. That means owners will invest more and more if they are getting more and more return, which depends on profits, capital and outputs and market shares, etc. Means if the owners are getting more profits, of course they will invest more and more, means capital supply will increase. So by attaining these two things, two factors, of course the managers can or the firms can attain the balanced growth rates that G is equal to, mathematically G is equal to, balanced growth rate is equal to GD is equal to GC. Means growth rate of demand is equal to growth rate of capital supply, that is GC. So if you are able to attain this, of course, the firms can attain the balanced growth rate. And he suggested that both GD and GC, both GD and GC should increase at the same rate to achieve balanced growth maximization. If it is going one hand, it is not possible to attain the balanced growth rate. So both has to be grow together, means growth rate of demand and growth rate of capital supply should increase in a same pattern. Then only the balanced growth maximization can be attained. So we'll discuss these things in the graph with the help of the graph. So let us take the first variable, which is GD, growth of demand, which represent GD. Mathematically, we can say it as F of dm bar. D means diversification, M bar average profit margin, which is constant. Let us draw the graph x-axis and y-axis. X-axis represents diversification, y-axis represents GD or profits. When we are diversifying, of course, GD will increase. So that GD curve slope upward. At to a particular point, then it will start decreases. Let's see the GD curve here. This is the GD curve. And you should keep in mind one of the things very important it is here, the relationship between GD and profits. The GD and profits are negatively related because when a firm increases the advertisements, customer services, etc., of course, demand will increase. If a firm increases advertisements, if firm increases advertisements and customer services, of course, the demand will increase. But due to the advertisement cost and the customer services cost and other expenses, of course, profit may decreases. So that profit and GD are negatively related. Let us see here, when GD increases at the constant rate of profit is not changing, profit is same only, but GD has to be increased. When GD increases, then the GD curve has to be shift upward. This is the new GD curve, means GD is increasing, but profit is same. There is no change in the profit. Then when GD decreases, it has to be shifted to downward. Profit is constant, profit will be less only. So here the new GD curve, because GD has got decreased. So new GD curve name is GD1. So here you can see that the GD1 means GD decreases, but profit is same. There is no change in the profit. And same time GD got increased, profit is same. There is no change into that. That's what shifting of GD curve is happening. With the constant profits, there is no change. It is less or higher. That's all the difference. So here it's very clear that D is diversification, M is average profit margin which is constant, and when diversification is happening, of course GD will increase and M and GD are negatively related. So the first variable is GD. Then we'll take the second variable. The second variable is that growth of capital supply, that is GC. Growth of capital supply, that is GC, which we can be represented as A bar F of dm bar. A bar F of dm bar. A bar is a financial security constraints which is also constant. D is of course diversification. M bar is of course average profit margin which is constant. Then look at this graph, x-axis and y-axis. Then here x-axis represent diversification, y-axis represents GC or profits, growth rate of capital supply or profits. Then draw the graph of profits here. This is the GC, growth rate of capital supply. Growth rate of capital supply. Then here also we can see that growth rate of capital supply is always depends on the profits or shareholders price. So the growth rate of capital supply will increase according to the profit increases, so that the profit and GC are positively related. So when profit is increasing, of course, growth rate of capital supply also will increases. When profit decreases, growth rate of capital supply also decreases. So shifting upward and shifting downwards. That's what this will happen. So we have gone through the two variables. One is the growth rate of demand and growth rate of capital supply. We are very clear about these two variables. Then to prove this theory, we are taking these two variables into one graph. Let us see here. X-axis is diversification, Y-axis is GC or GD or profits. Both has to be represented on the Y-axis because we are taking all graphs together. Both the growth rate of demand and growth rate of capital supply we are taking as together. So here we can draw the growth rate of demand GD, then increasing the GD, so GD 2, then decreasing the GD, so GD 1. Then we'll draw the growth rate of capital supply. This is growth rate of capital supply. Then growth rate of capital supply increases. Then growth rate of capital supply decreases. GC 2. So this is the combined graph which is showing the growth rate of demand and growth rate of capital supply. So let us identify some particular point here. So here the points at which where GD and GC is intersecting, GD and GC is intersecting, that point we can say it as equal to balanced growth maximization. That is what G is equal to GC and GD. G is equal to GC and GD. So we can see the point at which GD and GC intersects. So the first we can see where GC2 and GD2 is intersecting. You can see here GD2 and GC2 is intersecting at this point. We will give a name for this point that is called as P. Then you take next intersection at GC and GD. At this point it is intersecting. This point we can call it as Q. Then we'll see the third one, that is GC1 and GD1 is intersecting. This point we will take it as R. So here there is a point, there are 3 points where intersecting the GD and GC. Growth rate of demand and growth rate of capital supply are intersecting at 3 points. So by connecting all these points, we will draw a line which is showing the balanced growth curve. So this is the balanced growth curve. At this point, the growth rate is balancing. At the PQR curve, the growth rate is balancing. But here, we will be able to take only one point which is highest. That point is called as Q. That means at this point, at Q, at this point, the firm is able to make the maximum profit as well as the maximum growth, so that the company can say that at this point the company or firm will be able to attain the maximum growth because it is the highest point. This is what Mari is saying, that is when we are concentrating to the growth, both aspects, one means growth maximization for the demand as well as the capital supply, we can attain the balanced growth. This is what he said. Then let's see that some of the drawbacks of this theory. Criticism of Mari's model. So here we'll analyze one by one. The first one is assumes a fixed price structure for the firms. A firm has to follow the price fixed, but it is not possible. It is practically it is not possible to follow the fixed price for the all products. Then Ignore the problem of oligopolistic interdependence of firms in non-collusive markets. In oligopoly market, the firms are always dependent. This without depending one firm to other firm, it is not possible to work in oligopoly. That is ignoring in this theory. Then does not analyze interdependence created by non-price competition. Does not analyze interdependence created by non-price competition. Some of the other factors are there for the competition, not only the price. Quality may be, brand may be, then ingredients of the products. Many factors are there for the competition. That is also not considering here. Then it assumes that firms can grow continuously by creating new product which is unrealistic. Then applicable basically to those firms which produce consumers goods. Producers goods and industrial goods are not applicable in this theory. Then Marris lumps together advertising and R&D, research and development expenses, but in his model, but the problem is that it cannot be combined because it will varies. The cost to advertisement and research and development cannot be combined. The cost will be, of course, it will be varies. Then all firm cannot have separate research and development because it is very costly. Then the assumption that all major variables such as profit, sales and cost increases at the same rate is highly unrealistic. So these all are the criticism of Marris model. So I hope you understood, all of you, what is Marris model. Marris is saying that, let me come to the conclusion. Marris is saying that the growth rate of the company can be attained by following the attainment of growth rate of demand and growth rate of capital supply. Then only it can be attained. That is what he is saying. So here G can be attained only by GD is equal to GC, growth rate of demand and growth rate of capital supply. Then can be attained the growth rate, balanced growth rate. So thank you so much for watching this video. Hope you understood what is Marris growth rate, Marris balanced growth rate model. Thank you so much.